Yeah, you can do all this on your own, but why would you? I always am going to say the better deal for the client is to let us procure the funds for you. You're not going to connect with us unless you have a funding goal in mind. Nobody builds their business credit and invests the money to pay us because we're not expensive, but we're not cheap, you know? Like, you have to pay us for the work, right? Nobody's going to invest that kind of money unless they're looking to accomplish something with their credit. If they're going to walk into their regular, just normal bank down the block, they may get a loan. They're most likely not going to get what they want. Okay, most of the time they're looking for a lot more money than a local bank will provide. And even furthermore, a lot of the access to funds, especially with startup money, is going to be unconventional funding. Private equity firms, even just, working capital providers that aren't necessarily private equity firms, but private funded, if you will. That's going to mainly be the type of money we're going to get for them. If you go into a bank, they're always going to start you at their standard. Every different bank has a standard for a credit range of this to this. They're going to give you this much money at this rate, this term, right? If you go to a private money or a private equity firm or, just an investor with money, it doesn't have to be a firm or a hedge fund. It could be just somebody we know tons of wealthy people that are just looking to diversify their portfolio. Hey, if they like the idea, they'll lend the guy the money, or they'll ask them for a subscription agreement plus whatever the terms may be. But that's the whole point. We can structure the terms at that point. That's part of what makes us financial concierge more than just a loan broker or a credit repair person. We may get an offer. We're not going to shove that offer down the client's throat. We're going to thoroughly analyze the offer. We're going to find out if it's a good fit for the client. If it's not, we're going back to that guy. And whether he's our friend, whether he's an associate, whatever, we're going to say, listen, this deal fucking sucks, okay? We need something better for our client. And if we don't get something better for our client, there's like a lot of other people in our, cell phone Rolodex. We can just call them. And that's not even to throw our investors under the bus. We want what's best for our client, because if this client gets a good deal, does whatever they're going to do with the investment and quantifies that investment, they're coming back to us. And if they come back to us and say, I love that money, those rates were right on point, guess who we go back to? Right back to that very same investor who is willing to work with us, right? So it's even in their best interest. It behooves them to at least not kneel for the client or whatever, but at least concede to some of their demands too, to make it more of a fair transaction. When it comes to a bank, you're going to get a set of underwriting guidelines from Chase or Wells Fargo or Bank of America. If you don't fit that exact underwriting criteria, you're asked out. You're not getting the loan. Where if you go to the more unconventional, non-traditional types of funding, we can work around their, FICO requirement. If we got the guy up to 700 and they're like, well, we only accept 720 and over, well, we can more try to validate the income the person's making, the revenue the company's bringing in, the outstanding receivables, whatever the case may be, to kind of push that loan forward, where you can't do that with a traditional bank. They're going to look the other way. They got 1 million people filling out applications every day. They don't need your business. I think that it's much better for the client to let us procure the funds, because they're never on their own going to be able to, in the time they need, that is, procure the type of money they're looking for. I mean, if they want to go spend a couple of years like we did building relationships and, finding the right funding people, I'm sure they could do it on their own. But, it's funny. And we use this affectionately with our clients, because you have to use disclaimers with credit repair. It's by law. You have to tell someone that you can do this on your own. But that's like saying, I could go be a neurosurgeon. I just need to go to medical school and spend 7 years and develop the expertise and go extern for 5 years and then go work in the hospital before I actually get a position as a surgeon. You're like, yeah, if you're willing to go through all that, that's, or again, I could rebuild a transmission if I go to school for it. So yeah, you can do all this on your own, but why would you?
And why would they want to use us is because we're familiar with their situation, their financial background. I mean, once we go through the credit repair process, you got to understand that we spent months, nurturing this client, so we have a relationship, a rapport with them at that point. So we're going to go, fight to get the money that they need. If they go to a traditional bank to try to get a loan, they don't understand what that client's goals are. They don't understand what they're trying to do. For most banks, that's just another name on an application. And if you don't meet their underwriting requirements, they're just going to decline you. Whereas us, we're going to go to another source to try to pull some funding for you. So yeah, so they're not going to, if a client needs, let's say $150,000, they go into their local bank, most likely they're not going to be able to pull that kind of money. They're going to get offered, somewhere about 40, 50, just because their income probably doesn't match up. But we're able to procure funds from multiple sources. So I think we're the best bet for most of these clients that come to us.
You can probably get that 150, but they're going to want you to put up your house. They're going to want you to put up collateral on an investment that you don't know where it's going to go. So that's typically what they'll say. They may say no, but do you have equity in that house? Okay, go get an appraisal 6 to 8 weeks later, and after you've spent a couple thousand on an appraisal and doing whatever they're going to ask you to do to meet that underwriting requirement for the home equity line of credit or whatever loan product they're going to collateralize your house against. Well, what if you're going to open up like a teriyaki shop in the middle of Oklahoma, and it doesn't end up working out, right? And then you lose your house. So not only do you owe a bank like Chase $150,000, they got your house too. And so it's, again, you may be able to accomplish it, but is it going to be better for you? The outcome may be detrimental. You may get the money without using us, because obviously a lot of people will sometimes say, well, I don't want to pay the fee for a loan broker. I'll go to these local banks myself. But listen, the local bank is going to try to get everything out of you, and they're going to use their reputation. They're going to use their commercial airtime as legitimacy to prop themselves up and say that they're better than the other guys. You're going to go sign over your house, your cars, your grandma's double wide, whatever the case may be. Yeah, she's going to end up getting hers signed over too, and you're going to lose everything just to get that, in his case, in his example, $150,000, right? So yeah, no, in every case, it's better to think strategically. When you look good on paper, the sources that we use in most smaller, financial institutions and private equity firms, they will take that and they'll fund you with it. They'll see a person who looks good on paper and not ask the question of, can I pull equity out of his house? They're going to take that and it'll be good enough for them. And most of these big banks, they're going to get what they can before they give you the money.